Hi everyone. In this video, we're going to talk about a purchase of shares. So if we look at the before diagram, we can see Company P, a construction company, and Company S, an excavating company. They each have their own set of books and records and their own assets and liabilities. When Company P purchases the shares of Company S's shareholders take the money and go. Each company continues to operate. They each have their own assets and they have their own liabilities. They're separate legal entities. However, now Company P controls the board, management, and operations of Company S. Each company still maintains separate financial records. The only thing that has changed is the shareholders of Company S. However, consolidated financial statements will now need to be created. When there is a purchase of shares, the acquirer, which we will call the parent, purchases shares to gain control of the acquiree, which we will call the subsidiary or the sub. One company acquires enough of its voting shares to control the use of its net assets, usually the majority. Usually, management of the purchaser makes an offer to the shareholders of the acquiree, offering cash or shares in the purchaser for their shares in the acquiree. All that has changed is the shareholder. The buyer must prepare consolidated financial statements. However, both companies are still separate legal entities. Both companies still have their own books and records, financial statements, and tax returns. Why does the parent need to consolidate the financial statements of itself and its subsidiaries? The reason for consolidation is that we want to have a whole picture of the entity. It ensures that off-balance sheet transactions don't happen. Companies have a long history of using other companies that they have control over to hide information, as we discussed in a previous video with Enron. When we are consolidating an acquisition, each of the parent and subsidiary maintain separate accounting records and produce separate accounting financial statements. However, the parent must produce consolidated financial statements, consolidating the assets, liabilities, operations, and cash flows of the subsidiary with its own, as if it was one entity. Consolidation does not change the books and records of either the parent or the subsidiary. It is strictly a function of creating the consolidated financial statements of the parent. The consolidated financial statements are a completely separate set of books and records, a third set. They only exist at year end, and the basic starting point for a consolidation is just to add the assets and liabilities of the parent and sub together. And we do this in what we call a consolidation worksheet. For a purchase of assets, we bought the assets and liabilities onto the acquirer's books at fair value. Here, we do not record the sub's assets and liabilities on the parent books, but we will need to record it in the consolidated statements. The same principle applies when we create consolidated statements. The sub's assets and liabilities need to be recorded in consolidated statements at their fair value at acquisition. What actually gets recorded on the books and records is easy, just the investment at cost. So it would be a debit to the investment and a credit to whatever the payment method was, whether that was cash or shares or debt. You will see we will use the same information, principles, and steps, but we will use it to do a consolidation when we're doing a purchase of shares. In a purchase of assets, we used it to record an entry on the parent's books. In a purchase of shares, we will use it to do the first entries on our consolidation working papers. So let's start by talking about the consolidation process. Our step one, identify the acquirer and the date of acquisition. So it's really important, just as if we were doing a purchase of assets, to determine who is acquiring whom. The next thing is the date of acquisition. Again, so important because what we're going to be doing is recording the assets and the liabilities at their fair value. Step two, determine the acquisition cost or purchase price. So exactly the same as if we were purchasing a business by assets. Important because In a simple world, we would just be paying cash. But if you remember, in the real world, there's many different ways that you can actually pay for the purchase of another business. Our third step, determine the fair value of net assets and goodwill. So we're going to be using the acquisition differential table, and there's 3 different parts. The first thing we need to do is determine the acquisition differential, and we do that by taking the purchase price less the book value of the net assets. The second thing we would need to do is identify the assets and liabilities with their fair value being different from the book value. And then we want to allocate the acquisition differential to the fair value differential. Remembering that we also need to account for any of those items that might not even be recorded, that might have a carrying value of 0. So think about those intangibles. The remainder of the unallocated AD or acquisition differential is goodwill, or a gain on the purchase in the case of negative goodwill. So here it is in a diagram format. So we've got our purchase price less the book value of our net assets being our acquisition differential. Our acquisition differential can then be split into 2 different categories: the fair value difference and the goodwill. And so that is what we need to account for. So here is a quick little example of how to format our AD table. So we can see in this example, we've got a purchase price of $95,000. The next thing we want to do is we want to subtract off our book value of the net assets. So our net assets is our assets less our liabilities, or our common shares and retained earnings. So we can see in this example, we've got common shares of 25,000 and retained earnings of 33,000. So adding those together, our net assets or our equity is 58,000. This results in giving us an acquisition differential of 37,000. So we want to allocate that 37,000 between 2 things: our fair value differentials and goodwill, the remainder going to goodwill. So if we take a look here, we can see that there are differences between the fair value and the book value for our PP&E and our long-term debt. So PPE having a market value of $109,000, but only a book value of $88,000, giving us a fair value differential of $21,000. Our long-term debt, which would be in a credit position, so really important to keep our debits and credits straight here, having a market value of $29,000, but a book value of $30,000. So, and minus $29,000 minus a minus $30,000 is a positive $1,000. So we can see that our fair value differential allocation is $22,000. So subtracting that $37,000 acquisition differential less the fair value differential of $22,000 leaves us with goodwill of $15,000. I just want to make note here of, even though we are using the amounts of common shares and retained earnings, which typically are credits, we're using them to represent the amount of net assets, which is a debit. So it's important to retain this debit credit convention, as it can be very helpful in making complicated adjustments later in the course. So what do we do with this goodwill and fair value differentials? Where do we record it? So we never do our consolidation adjustments in the parent or the sub's books. They are solely for their own individual operations. These adjustments are going to take place in the consolidation worksheets at the year end or at the time of acquisition when we are actually doing the consolidation. And the reason why is this: the assets and liabilities still belong to the sub. The consolidated balance sheet is just showing what the parent's carrying values are and what it is that they invested in the sub at the time of acquisition, including that goodwill. When it comes time to consolidate, we need to eliminate the investment account to prevent double stating the investment, since we're going to be combining the assets and liabilities of the sub. We also need to eliminate the retained earnings of the sub because we just acquired it. The parent only shares in the retained earnings of the sub since acquisition, not prior to that. We need to eliminate the common shares of the sub because when we bought them, their value is captured in the net assets. Again, it avoids duplication. There are two different methods we can use. So there's the elimination entries and worksheet. So this is where we do the journal entries in our consolidation working papers and transfer them to the worksheet. Or we can do the direct method. We don't actually do the journal entries, but we put the information from the AD table directly into the worksheet. So let's have a quick recap. So when we're doing 100% acquisition of the shares, we have one consolidated balance sheet for the entire entity, the parent and the sub. Adding together the two balance sheets is a starting point, but we need to adjust and make eliminating entries. And we do this on the consolidation worksheet. So the first thing we need to do is eliminate the parent's investment in the subsidiary. They could use the cost or the equity method. The second thing is we need to eliminate the subsidiary's equity accounts, the common shares, and the retained earnings. The third thing we need to do is set up the subsidiary's assets at fair value, so using our asset differential table. And finally, we want to recognize goodwill using that asset differential table again.